Hello, I am Melissa Wade for Northern State Financial. In this message, Alan Grodin, president and founder of the firm, weighs in on the indexing versus active management debate.
In all our discussions, you'll remember, I've always stressed the importance of asset allocation as the key to investment decisions. By that I mean the percentages allocated to stocks, bonds, cash, and alternative investments. After that, which sectors of the markets? For instance, what types of stocks, what types of bonds, and what types of alternative investments? The last job we'll have is how to execute that decision. What vehicle should we use? Should we employ a strategy that uses indexing, or should we use active management? For this message, I'd like to provide you with an understanding of these different vehicles and how and where they may be used. I've asked Bryan Duffy, regional consultant with Genworth Financial, to join me on this discussion. Bryan's firm, Genworth Financial, uses all the approaches we've talked about and a few more worthy of discussion. Bryan, can you give me an understanding of the difference between active management and indexing?
Sure, and I think the names are somewhat self-explanatory. So indexing, oftentimes referred to as passive management, ultimately means you're creating either an asset allocation decision or you're building a portfolio of stocks or bonds, and ultimately you are owning that policy and those securities, those stocks and those bonds in the same weightings, in the same proportions, in the same asset allocation level, and you're going to own that policy in the same way over all different kinds of market environments. So if you're thinking around passive management at the asset allocation level, you might build an asset allocation decision. Maybe it's a 60-40 decision, and you will stick to that 60-40 decision, all markets, all circumstances. That's essentially what passive asset allocation and passive portfolio construction means.
So if you're 60-40 and it goes 65-35, you just go back to that original. You kind of rebalance on a regular basis just to stay where you are.
Yeah, so historically you would, exactly that, Alan, rebalance back to that portfolio, and you might do that on a quarterly or annual basis. So with some frequency, you would return back to your original design of 60-40, and you would own that over the life of the investment.
I understand there's a relatively new approach to indexing. Can you talk about that?
Sure, and I think in the industry, you've heard it as active indexing, you've heard it as enhanced indexing or enhanced fundamental indexing, and ultimately it's a way to think about delivering all the benefits of indexing, but trying to think through what some of the pitfalls and problems have been in indexing as well. So active indexing or fundamental indexing looks to solve some of those issues while still delivering all the benefits that traditional indexing have delivered. When you think about indexing, they do a couple of really great things for investors. Number one, it ensures you get full market participation. It gives you great transparency, so you know exactly what you own and you know exactly how much of it you own. It's also very helpful in building an asset allocation policy because indexes do a great job of owning those particular pieces of the market in a very pure way.
No surprises.
There's absolutely no surprises. You know what you own, you know how much of that you own, and it's very easy then to set some kind of a risk-return discussion around that because it's a very pure way to implement an investment decision or an allocation decision.
Bryan, can you give me an example where indexing didn't work?
Sure. If you think about the S&P 500 as an index, a broad market proxy, it was the first index built and it has the most assets in it today. If you think about having bought that in the late 1990s, let's assume you bought the S&P 500 in 1997, you would have owned, in that investment decision, a weighting in Cisco Systems, a broadly known, understood technology company. And you would have owned Cisco as a 0.4% weighting when you made that investment decision in 1997. Cisco at the time was trading at a price-earnings ratio of 35. 2 years later, you own 10 times as much Cisco. Cisco is now 4% of the S&P 500 because it's a market cap-weighted index. Cisco now trades at a PE of 130.
So you own more of the stock when it was a riskier proposition.
It's arguably a riskier proposition. From a valuation standpoint, it's rich now, not cheap. And because it's cap weighted, you own 4 times as much of the security. Probably not an intentional decision on your part, but it's one of the issues, if you will, of cap weighted benchmarks.
Thanks. In what types of markets does indexing work best?
Yeah, it's a very interesting question because there's a raging debate in the industry about does one approach outperform the other? When is passive better? When is active better? And the reality is that there's no single best approach, all markets, all circumstances. Active indexing will tend to outperform a passive indexing when we are being rewarded for greater risk management. So if we are in a bull market environment, if we are in a sideways trading market environment, we need to pay a lot more careful attention to risk management, to the allocation decision, to how much of each individual security I might own. In those kinds of environments, active management will tend to outperform because you are being rewarded for the attention you are paying to the risk management side of the equation.
So to repeat, if stocks are all going up in the same way like we've experienced in certain markets,
Sure.
indexing wins.
Yeah, I would agree.
But if we have a situation where some stocks go up and some down, active management works.
Yeah, because as we mentioned earlier, when you think about the experience that passive management delivers, it is going to deliver a consistent approach. Think about the landscape of 1982 to 2000. We were in the middle of a very long-term, which you might call secular, meaning long-term, bull market. You could have delivered a passively managed approach and delivered very meaningful results for clients. It was a low volatility market. Managers that were looking to mitigate risk were not rewarded for that decision because there was not, quite frankly, a whole ton of risk to mitigate. Think about, however, the landscape just prior to that environment and just after that environment. If you were managing money from 1966 to 1982, the reality of that time frame was the Dow went from about 850 on the Dow in 1966 to about 850 on the Dow 16 years later in 1982.
Wow.
If you were pursuing a buy and hold passive approach to security selection and asset allocation, you wound up where you started over that 16-year time period. That's an environment where active management will traditionally outperform.
Gotcha.
And we've seen that, unfortunately, repeat itself in the decade of the 2000s. So the Wall Street Journal has called it the lost decade for a reason.
Right.
And 9 years later, we are back to where we started. In that kind of environment, again, active management, with a greater awareness and attention to risk management, will tend to outperform.
Now, I guess the only question we're missing is what we're heading into, right?
That's the $64,000 question, isn't it?
Right. Index funds, exchange-traded funds or ETFs, mutual funds and separate accounts are tools. They are neither good nor bad in and of themselves. The value comes in finding the right place and time to use them. Bryan, thanks for coming in today. You were a real help.
It was my pleasure, Alan. Thank you for having me.
As always, I welcome your questions and look forward to the next time we talk.